Hey guys, welcome back to my channel. First of all, I want to thank you all for helping me. I recently hit a milestone with the channel. I hit 500 subscribers, and that means a lot to me. I know in a previous video I had hinted at maybe doing a giveaway of some sort, just to thank you guys that are engaged with the channel and give back a little bit. So one of you had suggested that I give away an account when I hit 1,000 subscribers. So I'm gonna do a very simple social media contest, and basically all you have to do is tweet or share on Instagram hashtag honest prop trader and share a link to a video of mine, and I'll basically put all of the names into some kind of random generator, and I'll pick a name at random and I will message you and ask you to prove that you are subscribed to the channel. And if you are, then you will get a 50K evaluation account with any prop firm that you choose. So again, thank you guys for the support. It means a lot to me. If you're watching it and you're not subscribed, please subscribe. It does help the channel. And so with that, I kind of want to get into today's video. This video is a response to a comment I received from one of you that asked me to kind of basically just share some basics and fundamentals of futures trading. A lot of these videos are made by people like myself that have been trading for years, and sometimes they're very advanced, and it's about chart reading and strategies, and but sometimes you just want a regular video about the basics, right? Like just the entry level stuff. And I feel like a lot of us don't do that. So I'm going to make this video to kind of just explain really simple stuff, and kind of hopefully it helps you become a better trader if you're interested in becoming a trader. So I'm going to start with this article from Investopedia, and they just basically talk about a futures contract and what it is, and the mechanics of it and how people use it. So a futures contract is a legal agreement to buy or sell a particular commodity asset or security at a predetermined price at a specified time in the future. So there's three things I want you to remember about this is the words legal agreement, in that you're basically agreeing to buy or sell something at a specific price at a future date, right? So those are the three things that are most important about this, right? Like you're agreeing to buy or sell something at a certain price at a certain point in time. And that's all it really is. And it is a legal agreement. This article they shared, it's a really long article, by the way. You can read it if you like. I'm going to put all the links in the description for the video. But they basically talk about the functions of futures contracts. I don't agree with all of them, but I'm going to read some of it to you guys. So futures markets have three fundamental purposes, and the first is to enable hedgers to shift price risk. So this is really important. I think the history of futures markets started with people looking to find ways to manage risk. Whether they wanted to take on risk or they wanted to take off risk, right? The futures market is a place where you can do that. And the second purpose that I think people use futures markets for is to speculate. This is saying that, risk is shifted from hedgers to speculators, which I kind of agree with. But I think in today's markets, you have no idea if you're really, buying from somebody hedging or somebody speculating. Like, there's no way you can determine that. But those are the functions, right? Like somebody's in the market looking to take off risk, and someone's in the market looking to take on risk. But the third purpose that they mentioned, I think it's important too. And they said that the third purpose is to provide information to decision makers regarding market expectations. And you definitely see this a lot with the bond market when it comes to interest rates, and it gives you kind of an idea of where people are or what the consensus is in the marketplace of certain things. So that's kind of it. Like I'm gonna give you an example of a hedger, and I'm gonna give you an example of a speculator. And it's important for you to understand which one of these things that you are, right? Because there's pros and cons to each. So I'm gonna just go ahead and share it with you. So I'm gonna make up my own example. Let's say that you are a farmer and you grow corn for a living, and corn is now trading at $5 per bushel, and you have 5,000 bushels of corn to sell next month, and you want to lock in today's price for your corn that will be ready a month from now. So what do? You go to the futures market and you sell basically the equivalent of 5,000 bushels of corn, if that's what you have. You sell it at today's price, which is $5 per bushel. And what you're basically doing is you're locking in the price, right? Because as a seller, you're agreeing to somebody, hey, I will sell you 5,000 bushels of corn for $5 per bushel, right? And the notional value on that is about $25,000. So 5 times 5,000, $25,000. Now, let's say, the contract comes to expiration and corn is now trading at $4 a bushel. Well, the contract the contract says you can sell it for 5. So whoever bought the contract from you, if they hold a contract through expiration and take delivery of the corn, they're going to pay you $5, even though the market price is now 4. Or they can also just close out the contract and take the $5,000 loss, right? So the farmer, he took off his risk, right? Like he didn't want to hold and wait to see what the price would be next month. The market was trading at a rate that he found favorable for his 5,000 bushels of corn. He wanted to lock it in, so he sold the contract and said basically to somebody else, I will sell you 5,000 bushels of corn for $5 per bushel, right? Now, let's say the price of corn had rose to $7. He would technically be losing out on $10,000 because when next month comes, he'll be sitting on basically $35,000 worth of corn. But because somebody bought that contract from him a month prior, they have the right to buy it from him for $5,000. But he's just gonna give them the corn, right? Like he's not paying them money out of his pocket because the price went up. He still has the option to do that. If he can close out the contract for a $2,000 loss and then go and sell his corn to whoever he wants to for $7. But what's the point? It's still going to be $2,000 gain, $2,000 loss. Like, so for him, the risk isn't really, there's not that much risk of him losing money out of pocket. He just basically will lose any advantage once the price of corn goes above $5 per bushel of corn. But that was the price he agreed to. He thought that price was good. He wanted that a month prior. So at the end of expiration, he's just probably going to just, send the corn to the buyer of the contract and everyone's happy. And you might be thinking, well, why would anyone agree to that contract? So we know, well, the farmer, he wants to basically manage his risk in case the price falls, right? That's why he sold a contract. Now, who would buy that kind of contract? Like, let's say you're Kellogg's and you make cornflakes or, whatever, and you need corn to make your cereal. And you're forecasting your expenses for the year and you think $5 per bushel for corn is fair. It's a fair price. And you basically want to manage your risk in case the price of corn goes up to $7, right? You just want to have consistency. So you would buy the contract because you're basically locking in at some future date, I'm going to get corn for this price. So, both both sides benefit. And in that example, both sides, I'd argue, are hedging, right? Both sides are hedging because Kellogg's going to buy corn no matter what. And then the farmer is going to sell his corn anyway. He has corn to sell. So it's not like he's speculating on price, which he could. He has a right to do that too. But the difference I'm going to share now is the example of a speculator. Let's say you are just a guy with a computer and some money, and you have a feeling the price of corn is going to go up, but you don't have any corn to sell. Well, you also can just go in the marketplace and buy the contract from that farmer for $5 or per bushel, right? And if the price of corn does go up to 7, well, you made $10,000. You as the buyer of the contract. And then you can sell that contract when it goes to $7 per bushel of corn and pocket your $10,000 in profit. Now, let's say you, the guy with the computer and some money, let's say the contract it goes down to $3 per bushel of corn. Well, you don't have corn to sell. You can't deliver any corn because you don't have any corn. So at expiration, you're going to have to close out the contract. And when you close out the contract, you're going to lose $10,000. You're going to basically sell your contract for $15,000 and you had bought it for $25K. And, you know, there you go. So I think the difference between hedging and speculating is speculating is inherently way more risky because you're kind of naked. Like you're going to the market just kind of betting on price, either going up or going down. Whereas as a hedger, you have the asset. So if the asset goes up in value, you have the asset. If it goes down in value, you're just delivering the asset. So it's not like you're coming out of pocket. If you're the seller, right? If you're selling the contract, you don't have to, take out any extra money to pay somebody. You're just selling it at the price you agreed on. So I think it's important if you're trading to understand if you're speculating versus hedging, because there's a difference, and the whole point of hedging is to actually manage risk, whereas speculating typically is done to make profits. And then I'm not gonna go into like the idea of which one's better or worse. That's for you to decide. We're all adults here. Something else I'm going to talk about is futures contracts, at least in the United States. They're highly levered, right? You don't need, like even the example with the corn, to open a position, the guy probably didn't need $25,000 to be able to open a position. Because the futures contracts, like depending on the brokerage you're with, there's a certain amount of money that they specify you need to open a position. And it depends on the broker, honestly. But typically it's a fractional percentage. It's a small fraction of the total value of the contract. So I'm going to talk about something called like notional value and the importance in determining this. So like if you want to determine the notional value of something you're trading, it's important to understand the contract unit and the price, and you multiply these two things and you get the notional value. So in this example, CME Group, they have 100 troy ounces of gold, and gold is trading at $1,000. So meaning each gold contract is worth 100 grand when it's trading at $1,000. Second example is if crude is trading at $50 and the contract unit is 1,000 barrels, that means the notional value of a contract is $50,000. S&P 500 futures, if the S&P is trading at 2120, which it's not, and the multiplier is 50, well, the notional value is $106,000. So this kind of comes in perspective, like if you're hedging, right? If you have a portfolio of, let's say, $500,000 of S&P 500 stock or whatever, right? You have exposure to $500,000 worth of S&P 500. You can hedge that in the futures market. Like, let's say you're worried something's going to happen or COVID's happening and or not COVID, whatever, something's happening. You can basically go in the market and basically reduce that risk by selling futures contracts against your position. So, you know, this is important to know. Like, when people are trading big size, they don't realize just how much value they're trading. So today, I think the S&P is at around like 4,100. No, I think it's 4,300. So if it's 4,300 times 50, we're looking at like over like maybe $250,000. Let's do the exact calculation to find out. 4,300 times 50. Yeah, 215,000. So if you're trading 10 contracts of that, you're trading $2.1 million worth of S&P 500 exposure, basically. And like, that's when it really starts to, these movements matter, right? If you're trading 10 S&P 500 futures contracts, that means each point is $500. So you can go down a rabbit hole with this, but know what you're trading. And you could determine that by going to websites like the CME Group. And also, I pulled up this chart from TD Ameritrade. And they basically broke down like tickers and the fluctuation per tick, right? So E-mini S&P 500, again, it's $50 per point. And then each point is like, it's in a quarter. Minimum movement is a quarter point. So each tick is $12.50. And you can kind of look at it for whatever your position you're trading. But you can calculate that. So if you're trading one ES contract, each tick is going to be $12.50. So each point is $50, and then each 10 points is $500 and so forth. So you can calculate that relatively easy. I hope this video helped the lady that asked this question. If you have any more questions about this, you can, again, send me another comment. But again, I just want to thank you guys for watching this. I want to also say that you can learn as much as you can about this stuff, but it does not guarantee success. Like, you can learn everything there is to learn about futures, and it's still no guarantees, right? Like, trading is hard no matter what. And, reading all day and learning everything, it could help you, but it's not a guarantee of, making you this perfect trader. And the example I can give you is, like, I can, if I give a toddler my phone to open a position, that position could be profitable. A toddler can go on my phone and open up a profitable position, and a guy with a PhD could go on his phone or his computer and open up a losing position. So education and knowledge is not everything you need to become a good trader, but I think it helps to understand the risk you're taking, why you're taking the risk, and just like making sure you're accepting the risks that's involved inherently with trading. But again, I hope this video was helpful to you guys. Thanks for watching my videos. And for the contest, as soon as I hit 1,000 subscribers, I will make a video announcing that I'll pick a winner, and I'll do the randomizer thing, and I will message the winner and let them know that they won. So thanks for watching, everybody, and have a good weekend.